Hello, everyone. Welcome to the webinar today. My name is Alexandra Alvarado, the Director of Marketing and Education at the American Apartment Owners Association. Very glad to have you all with us today. As you're coming in, I'm just going to go over a few details before we start. First off, this whole thing is being recorded as usual, and we will be sending you the recording tomorrow via email along with our speakers' contact information. So if you do have any follow-up questions, we can connect you with Scott Barney. He is a tax strategist and an expert, so he's a great person to ask your questions to. We will have some time today for Q&A at the end, so definitely put your questions in the question box if you'd like to see those questions answered today. And also in the chat, you can chat with people, but try to keep the questions in the question box so that we can keep track of those more easily. So a little bit about our speaker today as well. We've had Scott Barney with us before. I know some of you might be familiar with him already, but for those of you who aren't, Scott is with SV Consultants, Inc. He is a capital gains tax strategist and a financial services professional, and he helps clients to defer, reduce their taxes, especially upon selling a highly appreciated asset like your real estate. So he's worked many years doing this and has a ton of experience with a lot of alternate strategies. You know, oftentimes we're familiar with the 1031 and DST, but Scott has some other tricks up his sleeve that I think are amazing tools, really. I'm just so surprised that a lot of people, even CPAs, don't know about these tools. There are definitely, pros and cons. Scott is going to go over what those are for today's highlight, which is a complex spendthrift trust. So with that being said, Scott, thank you so much for coming back again. We really appreciate your time as always, and we're very excited to learn more specifically about this strategy, which I think we haven't done completely in detail yet. So I think we're all going to learn something a little bit new.
Yes, I think I'll fool you well today. No, thank you, Alexandra, for the opportunity. And as Alexandra said, I am a capital gains tax strategist. I'm in my 7th year of doing that. My background is I did real estate sales in Texas. I used to close anywhere from 50, 60, 61 clients a year for a good stretch there. I ran like a madman. That's why I look like this when I'm only 29, but that is my background. So I enjoy working with real estate professionals. I've done some real estate coaching. So when I work with them, with their clients who are looking to sell highly appreciated assets, I actually understand what the agent is going through. I'm also in financial services, life, long-term care, insurance, annuities, working with a team of financial advisors. So that is what I have as a background going into this. I've been doing capital gains tax strategies. Again, this is my 7th year. I started as a one-trick pony. And I learned one strategy. And then from there, I started learning more and more and more. And what I decided to do is build a breadth of strategies to help clients look at their case holistically and see what is a good fit. Instead of trying to make everybody fit into a strategy, I want to find a strategy that fits the client. So that's what I do. Disclaimer, while this is general information about a complex spendthrift trust, it does not constitute legal or tax advice. The best way to get guidance on your specific legal issue is to contact an attorney. I do train CPAs, I do train enrolled agents, I do train attorneys on various tax strategies because I'm out there finding those while they are not. But as I like to tell people when they ask me if I do tax prep work, I say I'm not that smart. So, but I do have fun educating real estate professionals, CPAs, attorneys, enrolled agents, and investors on what is out there. So today we're going to talk about tax deferral and asset protection trust. I like to call it a complex spendthrift trust. You're going to hear all kinds of names for it out there. There is not a specific name for it. They're usually named by provisions, and we are going to walk through that. Complex spendthrift are trusts That is naming two of the provisions of this trust. Nelson Rockefeller says it best, or said it best. The secret to success is to own nothing but control everything. Again, own nothing but control everything. And that's what this type of trust does. That was also said by his grandfather. So that is how you build wealth and protect wealth. A complex Spendthrift trust can solve the following problems. Capital gains taxes, number one problem. That's why people call me. I've got this tax bill. Somebody called me a little while ago. Sons are selling a business and want to know what can be done. So capital gains taxes, we have to pay taxes, but they can be a significant gut punch. And so we are here to try and solve the problem of that significant gut punch known as capital gains taxes, which, by the way, they're expected to go up. Problem number two is the 1031 exchange stressors. Many people call me because they want a different option than 1031 exchanges. Now, with the 1031 exchange, you have 45 days to identify a property, 180 days to close on that identified property. Well, because of those rules, 40 to 60% of the exchanges will fail based on the market conditions and what is going on. That's a huge failure rate. So either you complete the exchange or pay the tax. And people call me stressed all the time. What are they going to do? And so I help them to figure out solutions to eliminate those stressors. The current 1031 exchange proposals, because people ask me all the time, are they going to get rid of 1031 exchanges? I hear they are. Well, it's been on the table for decades. That's why you hear that they're going to get rid of that. But it's really considered as doubtful that they will eliminate 1031 exchanges. One thing you're going to find about me when it comes to projecting all these changes is I am always correct about these changes when I'm not wrong. So I'm always correct when I'm not wrong. So you can use that. I think I borrowed that from somebody else. Now, what they have proposed is to cap how much can be deferred in capital gains in a year. So if you're going to do an exchange, they want to cap it at $500,000 per spouse. So if you're married, $1 million in a year. So if you have a $4 million industrial building with $2 million in capital gains, you can exchange $1 million of that, and you have to pay tax on the other $1 million. So that is what is on the table right now as a proposal. So that is a way, a compromise. Instead of eliminate capital gains taxes and hurting the middle class that have investment properties, they're going after the higher wealth. So as a means to collect. So we can address the other $1 million in that example, but that is what they have proposed. Problem number 3, income taxes that reduce return on investment. What does that mean? And this is from talking to a lot of people. A lot of people do very well with their investment properties. A lot of people have not done nearly as well as they thought. So you take your rental income, minus your expenses, minus your mortgage, minus the taxes paid on the income after depreciation is taken, often leads to discouragement or a questioning of whether or not you can be getting a better return on investment somewhere else. I talk to people who say, yeah, my actual return on investment is really 1 or 2%. That's not good. I mean, that is really not good. I mean, I'm in the financial services. I've seen life insurance and annuities do way better than that. That doesn't mean you need to invest there, but getting 1 or 2% is not helpful for building wealth. And again, with that, that's not everybody, but there are people out there that have struggled because their return on investment is not what they thought it was going to be. Problem number 4, future tax hikes. So I like to follow the Tax Foundation to see what is going on out there. So there are different sites that you can follow to learn what are the current approved taxes or what is proposed. So what they have proposed is to raise the top capital gains tax bracket to 39.6%. That's just about double what it is now at 20%. You'd have to have $1 million of income and capital gains to hit that top bracket, but that's huge. And I'm in California, where we can't even buy a porta potty here where I'm at for $500,000. So there's large capital gains tax bills. So that's a proposed tax increase. They've proposed to eliminate the step up in basis. What is that? You buy a property for $200,000. If you sell it for $1 million, you have $800,000 in capital gains that you have to pay tax on. If you bought it for $200,000 and you pass away and it's worth $1 million, then the current step up in basis allows your beneficiaries to step up the cost basis from 200,000 to $1 million, so that if they sell immediately, there will be little to no tax paid. So they want to eliminate that. That's on the table to eliminate that. They want to cap the 1031 exchanges at 500,000 per spouse per year. Again, if you're selling properties every year, you have that cap that's applied each year. They also want to reduce the estate death tax exemption from 11.58 million, which is now a little over 12 million, to 3.5 million per person. But understand, already the sunset clause from the 2017-2018 tax reform will cause it to drop to about 6 million per spouse in 2026. So we already expect to go from, say, $24 million exemption for a married couple to 12, but it's been negotiated right now to drop it to 7 million per couple. And the current tax rate is 40% federal plus state, and they want to raise it from 40 to 45%. So that's a huge hit to your estate. And by the way, that's why a lot of people, especially up here in Silicon Valley, buy what's called second to die life insurance policies. They know that their beneficiaries are going to have to sell off a bunch of real estate to cover the taxes. So what they do is they buy large life insurance policies so that the life insurance will be enough to cover the taxes, so the beneficiaries will be able to keep their estate. Lawsuits. Don't have to say a whole lot about that. There's not a lot of solid asset protection out there. That is a common problem, and it's gotten worse and worse and worse over time. So even going back to, I remember when they had that big lawsuit because of coffee being spilled on somebody at McDonald's. So that is a problem. Problem number 6, it's easy to pierce, and this is tied to lawsuits. It's easy to pierce the corporate veil because they are tightly held entities. So corporations like S corporations, LLCs, don't protect you as well as you think they do. You are operating under your what they call alter ego. So the courts claim that you are controlling the owner of the entity. So it is a very winnable argument with the judge. That's a problem. Roughly 50% of the entities can be pierced because they are not operating their business properly when it comes to the records, the meetings, and the minutes. So if you have a corporation and you're just like, yeah, whatever with those minutes and meetings, understand that's how they pierce 50% of the corporations in a lawsuit. That's also an issue for a lot of the country, because 40% on average in state courts and federal courts is going to get pierced. So basically you have 4 in 10 chance that you're going to lose your assets anyways in an LLC and an S corporation. That's not helpful. So it's not as solid as you think it is. 60% chance you do protect your asset, but 40% chance you lose it with corporations. Problem number 7. Insurance is only a partial solution. You'll say, well, I've got the LLC, but I've also got umbrella insurance. Hey, that's awesome. But understand this about umbrella insurance policies. They often do not cover punitive damages or gross negligence. So you're at fault at a car accident. You ran a red light. you lose. And the award, that's gross negligence. You ran a red light. Your insurance company can say, no, you ran a red light. That's gross negligence. We're not going to cover that. And they often do not cover punitive damages. What's that? That's the punishment part of the award. So that could be 70% or 80% of the award, punishing you for your gross negligence. So you need to call your insurance company and say, hey, does my umbrella insurance cover gross negligence or punitive damages? However, you may still want to have umbrella insurance because there are benefits to having it. I have it both on business and personal. So it's helpful, but it's not the solution that you might think it is. This is a shocker. So depending on where you're at in the country, I'll give you a second to take a look at the states. They're in alphabetical order so that it will be easier to find. All right, filial responsibility statutes. Many states have these statutes, which allows long-term care facilities to seize the assets of adult children to cover unpaid bills of their parents. People don't realize this is out there. So mom is in a care facility. It is now costing $25,000 a month. Mom runs out of money. It takes 2 or 3 billing cycles to realize mom is out of money. So now there's a $75,000 long-term care bill. The facility can look to the adult children and say, mom owes us, so you better pay up or we're going to remove her. And people will go, the beneficiaries say, I don't have that kind of money. Then they can seize assets to actually get that money. So these are the states that allow for that. So you need to be aware of that. And right now, just so that you know, Washington did pass a state tax for a long-term care benefit. California and New York are soon to pass that along with 11 other states. So because the states are saying, hey, there's this problem called long-term care and people don't have the funds. So pretty soon, a lot of the states in the country will be charging a tax to W-2 employees. So you want to look into getting your own policy set up in advance. Reach out to me. I'll tell you what states they are. So that's all the problems. I always start with the bad news because I want to make sure that it makes sense. Whatever I present makes sense as a solution. All right. So what type of trust is it? I told you it's a complex spendthrift trust. The provisions are non-grantor, irrevocable, complex discretionary spendthrift trust. This provides both tax deferral as well as asset protection. This is significantly more beneficial than, say, a living trust. A living trust is there really to keep you out of probate court. That's all it's there for. This type of trust keeps you out of probate court and gives you tax deferral and gives you asset protection. So it's a much different type of trust. And these types of trusts with these provisions. Now, legacy trust, dynasty trusts have been around for a long time. But with all these provisions together, we're talking about the 1950s, so 70-something years. So quite a long time. The non-grantor provision helps to provide ironclad asset protection. Basically, how it does that is it exempts the trust from any alter ego status. Remember, LLCs and S corporations can be pierced because of that alter ego status. This eliminates that status. So let's say I'm starting a trust. I want to set up a trust. I will not be the grantor. I'm going to hire a company to be a grantor or have a friend be the grantor. The grantor is credited with the creation of the trust. They fund the trust, say $50. They appoint the guardian and the trustee, that would be me. And then they resign. And now I'm the trustee and trust administrator or guardian that controls everything. And that's when the assets go into the trust. Nothing is in the trust yet. So upon the grantor's resignation, the client takes over as the guardian and trustee and sells the assets to the trust. Irrevocable provision. This is also therefore providing ironclad asset protection. So it's really, if you want to have that protection, you want to have the irrevocable and non-grantor provisions together in a trust, as well as the spendthrift provision. So what does that mean? That doesn't mean you can't make changes. I mean, you won't change the document itself, but you can add assets to the trust. You can subtract assets from the trust. You can sell assets from the trust. The trust can buy assets. So there's a lot that you can do, even though it says irrevocable. The provision here basically makes it so that the assets transferred to the trust. Remember, there's a grantor and there's a non-grantor. I'm the non-grantor. Anything I bring into the trust, if I allow the trust to be unwound, because they go for 21 years, if I decide, you know what, I'm going to unwind the trust and distribute the assets. When that happens, the irrevocable protection says that the trust may never revert to the one who established the trust. That's the original grantor. So if I decide, or your beneficiaries decide to end the trust, the original grantor does not get access to those assets. That's the irrevocable provision. The discretionary provision defers capital gains taxes and even income taxes for generation. So that gives you the discretion to decide on what is to be distributed. And the key to this is to not distribute to beneficiaries. As long as you don't distribute to beneficiaries, there's no taxes to be paid in that year. So that is a tax deferral provision. Complex provision is also there. Complex, yes, this trust is very complex. That doesn't, that's not the reason why it's called complex. Complex is actually tax reporting type of provision. So this helps to defer capital gains taxes, because the trust alternates between simple or complex tax codes depending on the circumstances. As a matter of fact, in September 2020, Forbes had an article on eliminating capital gains using a complex trust. They wrote, one way to eliminate capital gains is through the use of a complex trust. Trust accounting is different than the more commonly used generally accepted accounting principles. And the distributable net income is calculated in a different manner when using a complex trust. When trust documents are implemented properly, you can effectively transfer control of assets from one person to another without triggering a taxable event. These trusts have their own EIN number. They are a different entity. Also, they wrote, there are many tools for minimizing or deferring your capital gains, but a properly established complex trust can allow you to have a more efficient tax structure, not only for capital gains, but also for wealth transfer. And that's also their disclaimer that I included in that. So the Forbes article from 3 years ago explains how complex trust reporting helps with tax mitigation. The spendthrift provision has ironclad asset protection and tax deferral benefits. It's the only provision that provides both of those benefits. And those have been around for a long time. Actually, spendthrift provisions have been around for, I think, 600 or 700 years. So the many of the castles in England are in spendthrift trusts. And so that way they cannot be taken in a lawsuit. This unique type of trust is designed to protect assets and defer capital gains and or self-employment income taxes. Now, there have been two examples, two exceptions that are found where these trusts have been pierced. Remember, I said LLCs can be pierced because of the alter ego status. The two exceptions found are what are called fraudulent conveyance. You've already lost a lawsuit. There has been an award granted, and you decide to set up a trust and protect your assets. That's what they call fraudulent conveyance. They will pierce it to get those assets, as well as court-ordered back child support. You know it's coming. You're supposed to pay it, and you go hide your assets because the amount of child support is reflected on how much assets and income you have. So if you go to hide it after it's been awarded, that is also connected with fraudulent conveyance. So you have to be careful. That's why they ask certain questions of you when you do an intake form. Now, case rulings supporting the spendthrift provision, there are case rulings that show that you can adopt any lawful means for the lessening of the burden of income taxes, and that there are courts that rule that a spendthrift trust organization is not illegal even if formed for the express purpose of reducing or deferring taxes. So there is case law, which I'm going to tell you a little something from a general perspective about case law. People will ask me with different tax strategies, is there case law? Well, there's not very much case law out there when it comes to tax strategies. There just isn't. Everything is operating in the gray. As a tax litigation attorney that fights the IRS in tax court taught us, it's in the gray. So it's all fact determinative. How it's set up, how it's managed, and how it's reported will determine whether or not it's going to pass muster. So there's not a lot of case law. 1031 exchanges had the Starker case from 43 years ago. There is case law in regards to spendthrift provisions, but outside of that, there's not a whole lot. So you have to make sure that whatever you do, you have good tax professionals working with you to make sure it's done well and that they can defend it. Now, this trust follows Scott on Trust Law. That's not me. That's a book called Scott on Trust Law. The Restatement of Trust, the Internal Revenue Code, the Uniform Trust Code, the Uniform Prudent Investor Act, Statute of Frauds, the Rule Against Perpetuities, which basically states that a trust cannot go on forever. It has to have an end date. So the longest trust I've heard of is 90 years. So, and this follows that. The trust can be drawn up for you anywhere in the US and is applicable to you where you live. That is because this follows federal contract law and not statutory or, as they say, state laws. And I'll give you a little insight. I had accounts set up for both my trusts. I have two trusts. And I had my account set up with Chase. And when they went through an audit of accounts, they determined that I was going to need to shut down my accounts. Why is that? Well, that is because, as they told me, my trusts follow federal laws and not state laws. And because they didn't follow state laws, the bank itself had less control over my accounts. So I went across the street to a very large organization and opened two trust accounts. So that to me was even more evidence that that was correct. So my trust follows federal contract laws, not statutory laws. So you can have a trust set up for you in Texas, and it doesn't matter where you live. You don't have to worry about the Wyoming LLCs and the Delaware and all of these, Nevada, all of these other states, because they're not statutory. All right, the trust has an option to renew every 21 years. That's that law of perpetuity. So it will end at 21 years. So you and your beneficiaries and your heirs to the beneficiaries can renew it with a stroke of a pen every 21 years. This can go on for 10, 20, 30 generations. It can go on for 1,000 years. So the tax deferral can continue on for 1,000 years. So the key is to not have distributions, and I'm going to go over that. This is basically the dynasty class of trust. You have Rockefellers, Carnegies, Kennedys, where they're able to pass on wealth in a tax advantage way and also protect their assets. So let's take that and break it down to a little bit more simple terms. So there are 5 living benefits of the complex spendthrift trust. You have the ultimate asset invisibility because this is not in your name. It has its own EIN number. So that is helpful right there. You have the ultimate in asset protection, a lot better than the LLCs, as well as the umbrella insurance. So the non-grantor, irrevocable, and spendthrift provisions provide you much more solid asset protection. Ultimate asset control. What does that mean? Well, if you can lose everything in a lawsuit, then how much control do you really have? So here, your assets are protected, so you have much more asset control. Ultimate tax benefits. This is the most dynamic tax mitigation tool I have found so far. That doesn't mean it's the most dynamic out there. It's the one that I have found to be the most dynamic in terms of what it can do for you. So it's the ultimate in tax benefits, and then true peace of mind, because if you have the tax deferral, you have the asset protection, then you can sleep better many times. All right. The complex spendthrift trust can defer capital gains and annual self-employed income taxes. That's why I have two trusts. The percentage of tax deferral on income will depend on how you structure it in coordination with a corporate structure like LLCs and S corporations and C corporations. LLCs are a lot better than S corporations. So typically, if you have a good income, and I'm not talking about somebody that makes $500,000 a year. If you're making $150,000 to $200,000 a year, it may be a good option depending on what's going on. So you can see 50 to 90% income tax deferral for your businesses, not W-2 income, but for your businesses. If you have a really strong W-2 income and you're in the top 3 tax brackets, I have a couple of things that I could do for you. So which tax code makes this possible? So because people will say, is this legal? Because they're afraid that I'm going to be pulling a Bernie Madoff on them or something. So yes, it is legal. So tax code 643. Now, I've seen opinion letters that will refer to 15 different tax codes and provisions. This is one of them. This is the one that is talked about the most because it's the simplest to break it down. Here's the highlights. Gains from the sale or exchange of capital assets shall be excluded in the year of reporting to the extent that such gains are allocated to corpus. What is the corpus? Corpus is the body of your trust. That's your trust accounts. That's your assets, like your primary residence. As long as the funds are allocated to the corpus and are not A, paid, credited, or required to be distributed to any beneficiary during the taxable year. That is really important here. As long as you're not distributing to your beneficiaries, you have to report the tax, but you don't have to pay the tax in that year. So it will be deferred. So items of gross income constituting extraordinary dividends or taxable stock dividends. Stock dividends does not mean like Apple stock. It could be even broken down to you have a cow, that's your stock, your milk is your dividend. So it is broad in interpretation. So which the fiduciary, that's you as the trustee, acting in good faith with managing the assets within the trust, determines to be allocable to corpus under the terms of the governing instrument. That would be your trust binder, your trust book, and applicable law shall not be considered income. So you're not going to be paying tax in that year. That's tax code 643. And again, this is one of 15 different tax codes and provisions that make this work. So what's not considered income to the trust by the IRS, according to 643? Well, we're talking about passive income, rental income, royalty income, interest income, dividend income, K-1 passive income, capital gain income. Now, some of you may be thinking, but you just said self-employment business income. Well, yes. So what happens is that you have a second trust, and I'm going to explain that. We'll have income, but then it expenses all that income as a K-1 passive to your first trust so that it gets tax deferral. Now, there was an audit recently done where the auditor out of the Western Division of the IRS, which is actually Southern California, is where they're located, but they are broader than California, decided to audit a trust because there was significant income to the trust and no taxes were paid. So they initiated an audit. Well, that auditor agent realized they were over their head, because when the docs were provided to that agent was like, I have no idea. I have no clue what this means. So what that auditor did was sent the documents to the trust division of the IRS. The trust division reviewed all the documents and sent out a no change letter to the tax professional and the client. That's huge. So it's the trust division that said, you're good to go. So, we're always looking for those no change letters in tax strategies. And I've seen opinion letters, I've seen a lot of things out there, but the no change letters are very, very helpful. As a matter of fact, we are tracking down, because we heard that recently there's a court case where the ruling was a no change letter counts as an opinion from the IRS. So we're trying to find out what court case that is, because that's significant, because that, saying that that's an opinion, that's something to stand on. Which also, if you have a CPA or an enrolled agents are federally licensed, CPAs are state licensed. If you have a tax professional who has a no change letter from an audit with one of their clients, they are allowed to use that no change letter as affirmative defense for any other client, as long as everything is structured just like that one where they got the no change letter. That is significant. So the tax preparer that does mine, he's got that no change letter. So that really helps. Now, there is a newer group out there, some friends of mine, actually, that will say, we do not agree with these claims about tax code 643 as the basis of tax deferral. They follow some other tax code, and I'm not saying what they're doing is wrong. That's part of a sales pitch, obviously, when you really look at it. But my response to that, when people have said, well, this person over here said that doesn't apply, that you really need to apply this code and everything. I say, well, ask them to provide the proof. Show me a letter where this was disallowed, because a colleague of mine who's a contract attorney that does contracts for big sales up into the billion range, who has one of these types of trust, or actually two trusts, for 10 years now, he's utilized the trust, and he does billion-dollar contracts. He found audits going back to the late 1980s that had no change. So if somebody tells you, wow, that doesn't work, show me the proof, or have them show you the proof where it was disallowed in an audit. That's huge. That's why you want to be looking at these things. Now, which corporate structures does this work for? This is best with LLCs and C corporations. For real estate, if an S corporation owns it, then the S corporation election will need to be revoked in order to get the capital gains tax deferral. That is, and that's if the underlying entity of your S corporation is an LLC. If it's incorporated, you've got problems. Now, understand this, an S corporation is an awesome tool. Your CPA was not wrong to encourage you to do an S corporation. It's only trouble when you try to connect it with these types of trusts. That's the only time that the S corporation is a bad thing. So what you've done is a great thing if you have one. It just gets a lot more complicated with these trusts. If the underlying entity of the S corporation is incorporated, nothing can be done. We have other options. Now, and part of that is because you're trying to sell off assets to the trust so the trust can get the tax deferral. Well, if you sell from the S corporation to the trust, it is considered a distribution at full value. So there's really no tax benefit there. For self-employed businesses, LLCs and C corporations provide the best tax mitigation. You can get 90% of tax deferral with those structures, maybe a little bit more in the C corporation structure. S corporations have the highest form of tax available. You have a W-2. And because you have to pay yourself a salary, there's nothing that the trust can do with the W-2 portion of that. So the portion that you have being paid out in K-1 distributions, some of that can be tax deferred with the management services organization agreement. So you will get some tax deferral, but not as much as the LLCs. Bonus insight, you should almost never put real estate into an S corporation. You eliminate the flexibility of transferring ownership of the property without creating a taxable event. And I get people calling me, I got this $14 million building. Well, how's it owned? S corporation. Yikes. So it limits the options. So if you decide to shut down the S corporation and put the property in your name, the transfer is counted as a taxable distribution based on the built-in appreciation. So you have to be careful, and you have to work with tax professionals that know what they're doing. Now, people will ask me, but what if they change the tax code? Well, it could happen, but I like what Lucy Parsons once said. She says, never be deceived that the rich will permit you to vote away their wealth. And that is so true. This is part of the original tax code that was ratified in 1918, tax code 643. Can it change? Laws can change, but we have to also balance that out with who are the lawmakers. They have wealth. They're building wealth as lawmakers. Who's funding those lawmakers? The wealthy. So if the lawmakers take away all of the benefits for the wealthy, they won't stay in power. That's the bottom line. So can they change it? Absolutely. Will they change it? It hasn't been changed in 105 years. They've tweaked it a little bit and added a couple provisions, but they have not eliminated it. Now, what are some of the assets that could be sold by the trust? Well, Bitcoin and cryptocurrencies. So, they just had the big XRP win against the Securities and Exchange Commission. So people are even more excited about the potential for cryptocurrencies and Bitcoin now. So you can have a trust to defer the taxes on the growth of that, stocks and bond market trading. This does not work for your qualified funds. What's that? That's your 401k, your 403b, your IRA. Those types of funds, those investments, you already have a partnership with the government. Basically, they're saying, hey, we're going to not allow you to not pay tax on $10,000 because we want you to pay tax on $160,000 later. So that's the partnership you have with those qualified funds. Real estate, businesses, art and antiques, so anything that can have capital gains can be utilized in a tax advantage way, sold in a tax advantage way by the trust. Now, one thing to understand about tax strategies is most of them are transactional. You set up a strategy, you pay for that strategy, you report from that sale for a number of years, decades. So most of them are transactional. With a trust, you can set up one trust and sell multiple assets and get the tax mitigation. So a lot of the people I talk to with 100 doors, 150 doors, not necessarily 150 properties, but 150 doors, say 40 properties, 30 properties, 20 properties, they can do all those transactions from this one trust. Intellectual property provision added to the trust. So how would you like to defer taxes on any income derived from intellectual property? That's books, membership sites, coaching, mastermind programs, home study courses, consulting. So you can actually defer taxes on that type of income as well. Active business income. The trust can defer active income taxes paid by those who are self-employed. This does not work for W-2 employees unless they have a side business. So if you're W-2 and you're in the top 3 income tax brackets, talk to me. I'll show you how to reduce those income taxes. So for this year's income, we have to do some transactions this year. Any business you are actively working or putting in the hours, like right now, I'm putting in an hour with you guys, so I have active income. So you can defer 50 to 90% of those taxes, depending on how you have things structured. So basically, if you have a $50,000 self-employed tax bill, you could potentially reduce it to between $5,000 and $25,000. Does that help with building your estate? It helps a lot. Now here in Silicon Valley, that's an extra 10 trips to Starbucks because it's so costly. But that's a way to build your wealth by deferring those taxes. Active business income ideal scenario. So remember, I told you that there's that no change letter. So this is how he got the no change. You set up an LLC to run the business. You have 2 trusts. The second trust is set up, so you have a beneficial trust that owns your assets. A second trust is a business trust. The business trust is a 90% limited partner of the LLC. So the LLC pays out a passive K-1 income to the business trust. The business trust then reports that income, but we'll pay all of that out unless there's expenses with that business trust, all of that out by the end of the year as a K-1 passive income to the first trust. So it washes out. So 100,000 in, 100,000 out. Goes to the first trust. The first trust gets the tax deferral because it does not distribute the funds. So that is what got the no change letter. That's a way to defer 90% of your income. Short-term rentals. So you have the Airbnb, you have the Verbos. Many tax professionals consider that as active income. So that trust structure I just told you about, set it up. I mean, you can have a 90% limited partner from just the beneficial trust, but I would say have the 2 trust structure because that did get the no change letter. And if the IRS is saying, but that's active income, you're better protected in an audit. So again, not all professionals agree on this. Some will say rental income is rental income. Many will say, well, that's active because it's short-term rentals. So if you ask 5 CPAs a question, you're going to get 7 answers. You don't always get consistent answers. That's because you don't get consistent answers from the IRS agents either. So it's based on reasonable interpretation. And can it be defended? So now let's break it down even more. Let's get very practical. So the Nexus trust rule. So I am a consultant with Nexus. You own nothing but control everything until you die. If the trust owns it, the trust always pays the bills, not you. This is huge. You have a primary residence in the trust. You have income in the trust, which, by the way, you really need to have a funding source for the trust in order to make it a viable option for you. So if you wanted asset protection, you can get an asset protection only trust. This would not make sense. Primary residence is owned by the trust. Therefore, the trust is responsible for paying the bills. So you have income coming in. So now you're paying those bills with pre-tax money instead of post-tax money because the trust owns it. So you save a lot of money that way. It's also required to pay the bills for the health, the medical, and welfare costs for all beneficiaries and trustees and guardians. So when I go through back therapy every week, my trust pays the bill pre-tax. Education costs for beneficiaries under age of 21. So there's a lot of pre-tax benefits when the trust owns the assets. So what are some of those expenses? Well, you have your home expenses. If you put your vehicle into the trust, you have the vehicle and the gas and the maintenance. But understand this, that you have to pay caretakers leases on these, and I will get into that. Medical bills, charitable contributions, tuition, room and board at college up to age 21, wellness, that's like back therapy, interest on credit cards, phone, as long as the trust owns the phones, life insurance premiums. And if you get into the whole tax planning with the 7702 of life insurance, we can talk through all that and the benefits of the trust and where it's not beneficial. Bank and credit card charges, postage. So, all the trust expenses can be done pre-tax. What it does not cover is fun, food, or fashion. Those Alaskan cruises, or your groceries, or your clothing, unless it's tied to a business, which I pointed to that, but that's Stanford. That's not business. So it does not pay for fun, food, or fashion. And people say, but then how do I get money out to pay for my bills, my groceries, my travel? Well, here's how you do that. You sell your assets to the trust. So let's say you sell a home for $500,000. You can sell it at cost or at book value. Cost, if it's your primary residence, if you paid $200,000 for it, you've lived in there 2 years, so you get a $500,000 exclusion, capital gains exclusion. If you're married, so that's now $700,000. And if you put $100,000 into improvements, $800,000, that's what you sell the home to the trust for. If it's an investment property, cost or book value, your cost basis plus improvements minus all depreciation taken is your book value. You sell it to there. Now you create a demand note. The trust now owes you money based on the value, because the trust doesn't have the money to pay you when you sell it to the trust. So each year, you can do it monthly, you could do it annually, you can have the trust pay you a portion of the funds owed to you by that trust. There will be a small interest rate known as the applicable federal rate that the trust owes you, so a very small portion of the funds will be taxable. Why is that? Because it's a legitimate demand note, and the government requires that interest is tied to that demand note. So if you pull out $20,000 to go on a trip, and the AFR is 5% at that time, so 5% of the $20,000 is $1,000. So you're going to report $1,000 as interest income to you from the trust, and you pay $100, $200, $300 in taxes for pulling $20,000 out. So that's one way to do it. In some cases, tax professionals want you to sell the asset at more of a reasonable value or market value, and then you get a much higher demand note. So your tax professional will then report an installment sale agreement within the trust, where the trust owes you principal and capital gains and interest. So as you pull money out, maybe you'll pay some capital gains taxes at that time. So it depends on the tax professionals and what you decide you're going to sell the asset to. So you have flexibility on what that is. Now, if you time it well, you can actually have a higher demand note. If you can get your income and capital gains in a year, if you're married, within $89,000, then you'll pay zero income taxes or capital gains taxes. So there's these tricks that you can do to leverage things even more for you in terms of the numbers. And then you'll pay ordinary income taxes on the interest that you receive from the trust. So again, you can sell it at cost value, book value, reasonable value. You have options. By doing this, you could also potentially increase the chance that your Social Security will not be taxed. And some people will go, what are you talking about taxing Social Security? If you are married and your income exceeds $44,000, then up to 85% of your Social Security becomes taxable income. So in our financial office, we already call it Social Security instead of Social Security. It's a so-so check. And then 85% of it becomes taxable after you've already taken out costs for Medicare. That's super discouraging, but this trust could make it so that it's not taxable if all the numbers work out right. An important note is that you no longer own the assets. It's a legacy plan. You don't own it, you control it. It's a legacy plan for your beneficiaries. You control and manage the assets. So essentially, as the trustee, as you are the caretaker of the estate for the next generation. These are generational trusts. As the caretaker, you will pay what is called a caretaker only lease for the room that you sleep in and not the whole house, because you're managing and taking care of the estate. The great news is this can be deducted from your demand note. So you don't have to write a check to the trust. The trust already owes you. So you deduct it from that demand note. So you're not paying out of pocket. The same would apply for the vehicle, where you lease the vehicle and you reimburse the trust for mileage used for non-trust use of the vehicle, such as grocery shopping. So all that is coordinated with a bookkeeper and your demand note. So some people will put their vehicle into the trust, some people will not. Everybody is different. Now, real estate investors, this is where it gets to be fun. All right, the trust provides a solid alternative for 1031 exchanges. The trust sells the asset. The sales proceeds go to the trust. There are no restrictions as to when those funds are to be used. You have those highly restrictive rules for the 1031 exchange, which causes 40 to 60% to fail. Here, you can sell the assets as long as you don't distribute the funds to trustees or beneficiaries. You get the tax deferral. Then you can choose to invest outside of real estate. So for a lot of the people I talk to, they don't want to deal with the tenants, the trash, the toilets anymore. So they want to invest in stocks, bonds, mutual funds, cryptocurrency, whatever it is that they want to invest in, and not have to deal with those issues anymore. Or you could buy real estate, but when you find the right fit, not dealing with the timing of the 1031 exchanges. You know, some people are trying to sell off now while they're still getting a reasonable value for their properties, and they want to wait to see what happens in 1 or 2 or 3 years to see if there's a drop in values to where they can swoop in and buy at a better value and get a better return on investment with the rents and everything else. So you have that flexibility. Business owners, the sale of a business, there are multiple strategies available. The trust can defer the capital gains taxes on the goodwill portion of the sale. That's the reputation. I'm working with some clients right now that have a $190 million offer for their business, and 2 of the 3 partners are looking at doing the trust for the tax mitigation. But there are other taxable consequences, such as the sale of equipment and inventory, that need to be addressed. If you have equipment and inventory, that counts as ordinary income. The issue with businesses and sales of businesses is that the seller wants to put as much into the goodwill portion of the sale because their tax mitigation options are much broader than with equipment and inventory. The buyer wants to put as much into the equipment and inventory as possible so they can have greater depreciation. So there is this rub that happens in the negotiations. We can work with them on the goodwill portion of it. We can add other tax strategies for the sale of the business that are connected with the trust if needed, in order to increase the tax deductions in the year of the sale. So we can layer strategies like an LLC with charitable intent plus the trust. So there's other things that are out there that we can work with. So to wrap up, why haven't I heard of this before? That's a very common question. So my typical answer now is, when was the last time you went to coffee with a billionaire? Never. Well, how many of those types of people does your CPA work with? None. That's part of the issue. And there are people like me that are getting the word out for the middle class and the upper lower class to find strategies out there that the wealthy have used for many decades, but you were not informed of. Also, when you look at trust out there, 99% are revocable, 1% are set up as irrevocable. And of the irrevocable trusts, 99% follow grantor rules, and only 1% are non-grantor. And then of the non-grantor irrevocable trusts, about 99% follow simple tax codes, and only 1% follow complex tax codes. So 1% of the 1% of the 1% of the trusts out there have a chance of being this type of trust. So that means you have to know 10,000 people personally that all have trusts to find one that has this type of trust. So CPAs are not even trained on complex tax reporting typically. So the CPAs won't even know about these things. So I have CPAs that have come to me going, you know, where do I go to learn about this? So it's out there. You're just not going to see it as a regular thing, but the tax strategy is growing at a very fast rate. So by the time 2035 comes around, I would say majority of investors out there will be familiar with this type of trust. So what is the downside? Common question, great question. Well, the only downside that I've found so far is that you have to learn to live out of trust. That first year is a fog. You pretty much have to work with a bookkeeper to know how to do the bookkeeping, or have them do the bookkeeping. You know, what is a trust expense? What is not a trust expense? My wife will ask me on occasion, am I using this, you know, with our personal credit card or the business card? You know, she's got a lot of it figured out now, but she'll check with me for confirmation. So you have to learn to live out of a trust. It's very different. It's got the bookkeeping and the tax reporting. It's very different. So you can plan to be in a fog in that first year. Also, oh, by the way, typically trust organizations should provide you services, professional services, to help you through that. The other downside is tax strategies typically come out of the sales proceeds. Most of them, not all of them. People know of charitable trusts. Well, you have to set that up in advance and donate the asset to the trust. So you've already paid for the trust. Same thing here. You have to pay for the trust in advance to get the tax mitigation, because the trust has to already own the asset. You've already transferred the asset to the trust to get that tax mitigation. So the gut punch is up front, as opposed to out of sales proceeds. Trust timing and process. You know, if you meet with me, you've watched a presentation, you might watch the presentation over and over again. You'll read the trust executive summary in advance, other documents. So there are many conversations that have to happen. I want to vet it out to make sure it's even a good fit for you. I talked to somebody today and said you know, your two kiddos that are selling business based on how they're selling it, I said they ought to pay the tax. It would be a lot better for them. So I need to make sure it's a good fit. So I've talked people out of having a trust, as well as helping them to see the value of the trust. All right. Now, when it comes to trust, typically you see $30,000 to $40,000 on average, sometimes $25,000 for these types of trusts. Like I said, they're a gut punch up front, but it's going to help with all kinds of transactions, lots of transactions. And then even if you sold one big property to get tax deferral on one property, and you go invest in the stocks, bonds, and mutual funds, anytime you sell off those assets, you're getting tax deferral. So a lot of transactions still may happen. So the group I am connected to, their trusts are $15,000 per trust. So in my case, I have 2 trust books. So that's $15,000 each. If you do that, then you can buy a range of professional services hours ranging from 7,000 to 42,000 on top of the trust books themselves. So the trust books are $15,000. Now, the first year's tax return may or may not be included. The top 2 packages includes the first year's tax reporting. Usually tax reporting, you're talking about $2,000 to $2,500 on average for a trust. It does not include bookkeeping. Bookkeeping could be anywhere from $150 to $400, $500 per month, depending on the complexity. If you got 150 doors, it gets a little bit more complex. So that is outside of the cost. And now I will stop the share. I will put up my better looking self. Okay, no, I'm kidding.
Thank you so much, Scott, for the information. I'm getting a lot of thank yous. Everyone, I know you, Scott, just went over so much information. We're going to send that over to you tomorrow via email. Regardless of whether you've asked for it or not, you're going to get an email with the recording and Scott's information. I had a poll question up earlier. So if anyone said yes to getting a consult with Scott, I will expedite that process and send your email to Scott after this so that you all can connect together. That is really, I think, the best next step is just to figure out if this is something that is going to work for you. We did have some really great questions come through on, well,
And before
everything.
you start the question,
Yeah.
I have a trust overview document.
Oh,
Shall I
nice.
put that in the chat box right now?
Yeah, go ahead and put it in the chat. And then also if you can send it to me, I will include it in the email tomorrow as well, just in case people don't get a chance to download it. That's really helpful.
Yeah.
So some questions that came in, Jane asking here, is there a dollar or rental unit limit in the trust, or do we need to set up a separate trust for each rental property?
Now you set up one trust and you put all of the, so you have two ways to do it. You can have the trust own all the assets, or you can have LLCs where the trust is a 90% limited partner. It just depends on what you work out with the tax professional. So one trust covers all of it.
Great. And VJ asking, are you the trustee of the trust?
So now if you want to buy a trust and put assets in and make me the trustee, I would love that. But yes, when you set up a trust, you will hire or have a friend be the be the grantor, and then they resign, making you the trustee and trust administrator. So you can add trustees and you can add beneficiaries. You have that kind of control. So you're not giving control to anybody else. You're the one controlling everything.
Great. So Ho Yang asking, please reconfirm that due to IRC 641, the trust can defer the income such as rental, business, and capital gain as long as you do not distribute the cash to the beneficiary.
Yes, so 643, but 641 is also one of the provisions in there. Yes, as long as you are not distributing cash, making distributions to the beneficiary, you get tax deferral. And, people will go, but what about if I want to get funds out of there? Again, you have the demand note. And as the trustee, you can be paid a salary of your choice from the trust. You have to just report that as ordinary income. So there's ways that you can get it as don't distribute it to the beneficiaries. That's the discretionary provision of the trust.
Yeah, Alexandra, fellow Alexandra on the call. Hi. She's asking if the problem with LLC and corporations is piercing the corporate veil for failure to maintain formalities. It sounds like the bookkeeping and problems with tracking expenses to ensure that correct allocation is worse than the minimal reporting for an LLC. If you mess up in the trust, does that disallow the trust?
Yeah, so what will happen is if you don't do it correctly, you might not get the tax mitigation for that year. Then it converts to simple trust reporting. You might have to pay some taxes, but then the next year you get it corrected. That's why it's important to work with the tax professionals and bookkeepers that know what they're doing. 30% of the people will do their own bookkeeping. So we do our own bookkeeping, but I also, next month, I have a meeting with a bookkeeper, making sure everything is, so I'm contracting out for guidance.
I mean, it makes sense. If you want a certain benefit, there's going to be some hoops you're going to have to go through. I think that's sort of something to weigh in your pros and cons if it's a strategy you're looking to do, because, it's for some people it's totally worth it to go through that extra effort, just kind of depends on you, I guess, and what you think is worth it. So let's see here. James asking, what portion of your assets do you, Scott, have in, does it say have? Or HCW? I wonder what that is, in the Spendthrift Trust. So James asking what portion of your assets?
So for me personally, all
Have,
my assets
okay.
are in the trust. So I have to do a vehicle lease and pay back mileage for personal use, fun, food, fashion stuff. So everything's in there. Now, I have a second trust put. And the second trust actually, because I'm in California where we pay a weather tax here. I mean, we pay so much taxes here. So I'm kidding on the weather tax. We just love the weather, so we stayed. That's what keeps me out of those top tax brackets. So I tell people, depending on how you have everything structured, you should never, if you make $500,000 or $1 million a year, you should never report more than say 150,000 of income. So I do have an S corporation, by the way. I'll just be real honest. I have an S corporation. So my tax mitigation is a little bit different, except that my wife is out with horses right now. So I have an expensive fund. So I'm okay with paying myself a salary to have enough for the extra fund. My daughter is probably out with her 2 horses right now. So for me, that works. I don't need the 90% because I have to have more horses.
That makes sense. All right. Well, Kish is asking if you have just set up an S corporation for real estate and you have not moved forward on the business, can you close out and shut down the S corporation and then set up a Spendthrift Trust?
Yes. If you don't have any assets into that S corporation, you're good to go.
Okay, good.
And the CPA might, or enrolled agent might even say, hey, we'll set up an LLC instead and do it this way. Everybody's different, but yes, if you don't have any assets in there, now's a good time to say no.
Yeah, change my mind. Okay, Laura asking, what about the new ruling on irrevocable trusts and the stepped up basis? IRS quietly changed the rules on your children's inheritance. It looks like that might be referring to an article or something.
Somebody's doing their homework.
Yeah. Such as your home held in an irrevocable trust that is not included in the taxable estate at death will no longer receive a step up in basis. Here's why the wording of that is key. So that's interesting. Any comments on that?
I do, because I've had prospective clients send that to me. Different organizations, publications have sent that out. And here's a simple answer. Those are referring to grantor trusts, where you are the alter ego passing the asset. This is a non-grantor trust. It's a totally different type of beast. So, but that's a good concern. And I want people to always bring me anything they find as a concern. And if I don't know how to answer that, I've got attorneys and tax professionals to call on. But we actually looked at that going, wait a minute, is this of concern? And after further digging, there was a grantor trust. That does not apply here.
Yeah, absolutely. And I think it says a lot that you're using this strategy. And obviously, even for your own personal knowledge, you would want to know like what's going on. And makes a lot of sense that you would stay on top of it as well for that. Dan asking, I think you already covered this, but under what circumstances would the trust pay taxes?
So if you distribute to beneficiaries, there's going to be taxes. Now, understand this. All trusts have taxes. There is not I mean, when you get in a charitable trust, you're getting into a whole different taxable beast where they can eliminate taxes. But typically trusts that have assets like this pay taxes. It's just a matter of when. So when you distribute to beneficiaries, a tax is going to happen. If you don't manage things well and report it well, in that year, there could be taxes due. So, but otherwise you can keep that tax bucket being kicked down the road for hundreds of years if you do everything right.
Okay. Michael saying here, doing new construction, can we 1031 through the trust?
New construction. You don't 1031 through the trust. If you're doing new construction, you can either set it up that the trust owns the asset and gets the tax benefits, tax deferral benefits, and then you buy whenever you want. Or with a new construction, you LLC it, 90% limited partner, defer 90% of the taxes, just pay tax on the 10%.
Okay.
That's active income typically. And
Gotcha.
developments like that developments are not qualified for 1031 exchange to begin with.
Right. VJ asking, can your children inherit the property without paying tax?
Yes. And the thing is that right now, if you have a lot of assets, then the estate tax comes due. So you have to deal with that exemption, which is going to drop. When you live, the trust owns the assets. When you pass away, trust still owns the assets. So there is no estate tax. But as the trustee, you've made the beneficiaries the next group of trustees. So then they take over the control of the trust with the asset and still have the tax deferral.
Got it. Okay. And I guess that answers Alexandra's question. What happens to step up in basis upon death in a non-grantor trust? So, okay. VJ asking again, I think you covered this, but what is the annual cost of running the trust?
The trust itself is, you've already established it. You've paid, say, for professional services hours that could be good for 5 to 7 years. The annual cost is going to be bookkeeper. If you decide to use a bookkeeper, that's out of pocket, $150 to $400. Could be more if you're really complicated. And then your tax reporting, let's say $2,000 to $2,500 a year per trust. I have to do 2. So I have to pay about $4,000 or $5,000 for the 2 each year. And again, it could be more if you have more complications. My $190 million business sale, it's going to be a little bit more complicated.
Yeah. Okay. Raul asking, when you sell your real estate to the trust, you have to go through the same process as selling real estate to someone else, title companies, etc. No.
Nope. You
Nice.
basically have, I got the forms here. You basically will do a bill of sale. You got forms that they will send you, bills of sales, demand notes. And that the timing of recording the sale to the tax entity, your local county, you don't have to record it right away. A lot of people wait until they go to sell the asset before they record it, so it shows as the trust selling it. That way you can prevent the loan being called due and payable. So there's all these different things that you have to apply.
Okay. Lucy asking, and this might be something to follow up with her on, if I only own my house and a fourplex, is it worth setting up this kind of trust?
That's a wonderful question. Maybe, maybe not. It's
Right.
worth. By the way, my consultations are free, so use my time, please.
Yes.
So, and I will tell you if it's worth it. So it's really looking at the numbers, and so it may be, and it might not be. It depends on your income, when you think you might sell, what are your needs and goals? Do you have other investments, non-qualified investments that make sense to include in that? So the answer is, I don't know until we dig a little further. It may or may not. And I'll be quick to say, don't do it.
Yeah, I know. I've heard you do it. It's good to have someone like you, I think, that can really just break it down and give you a reality check on, what's the best move for you. I mean, I'm just so glad that there are other options out there so that we don't have to feel so limited in all of the, real estate kind of boxes that we keep getting put in. And I think that you've done a great job at really explaining this one really well. And this could be a really good option for a lot of you on the call. So really, like, the next step is to talk to Scott. So yeah, Scott, thank you for putting that. If you want to schedule with Scott, there's also a link he just put in the chat if you want to just click there. I'll include that tomorrow in the follow-up email. If you already said yes, that you want to have a consult as well, I'll let Scott know you already raised your hand in that poll. So I'm glad that all of you seem to have learned a little bit. I got some really great comments already. Someone said it's a blessing what you've shared with us today, which is really nice. I really appreciate, Scott, for your time and your expertise. We're always learning something new from you, and I think, we just have to keep asking you for more updates in the future.
Well, and for everyone, while I do this trust, I look at the case and I'll let you know what options are out there. People need a dose of hope sometimes, and sometimes I can provide that. So, but I will be real and I will be honest. I look at things holistically. So
Good. Thank you. Everyone's saying thank you. We are so glad that you came on to talk. I hope you all have a wonderful day. We'll connect with you soon for the next webinar, and take care, everyone. Bye.
bye.